You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kaastrup-Larsen, are delighted to be back with this week's edition of the Systematic Investor series. And as usual, we're going to discuss last week's events in the world of rule-based investing and take some of your questions. Good morning to you, Jerry, and good morning to you, Moritz. How are you?
Good morning. For the first time, I can say that. Good morning, Niels. Good morning, Jerry.
Good morning, guys.
Now, nat gas, once again, took center stage when it comes to market moves with a 12% drop this week, and other energy markets were under pressure as well as a few of the soft markets that also lost a fair bit of ground. And on the upside, we had lumber, had a big move. I don't know if any of you guys trade lumber. We don't. But there were also some up moves in things like the British pound, precious metals like platinum, gold, silver, and some of the grain markets had an effect on performance, no doubt, this week. So let's find out how all of this played out. And as usual, Moritz, even if you're might be a little bit jet lagged still, I thought I would come to you first and see how that all played out on your side this week.
Yeah, the jet lag was playing out fine as well, if I can say that. I got up so early in this morning so I could watch the final of the Australian Open, which for me as a tennis player is a good thing to watch. It was a quick one. But back to the markets, not trading lumber, unfortunately, a relatively small market, but not trading that for other reasons. And in terms of the performance, I mean, natural gas, I think they had a blizzard or a cold spell forecast for the eastern seaboard here in the US, which then didn't come, and so prices dropped again. My position in natural gas at that point isn't that large anymore, so it wasn't a big P&L event in that sense. Money was made on the bonds once again, favorite markets these days. Precious metals, and again some losing positions on the equities, but overall the week I think is a few basis points up even. So just chopping around.
Yes, no, I mean I can certainly concur on the slight positive performance this week. That was really also what we saw, and there were really for us a couple of standouts on the downside. British pound was really where we saw the most money being given away, and then fixed income as a whole pretty good, but German bunds, despite the low interest rates, we are able to squeeze out more performance of these markets, which is in itself quite incredible. So that did well. A couple of the energy markets did okay. Sugar did okay. Lean hogs did okay. Lost a little bit of ground on coffee, but it was a very quiet week at the end of the week. Slightly up for the week on our side. So how about you, Jerry? What did you see? Not least, we're always excited to hear what the single stock markets looks like.
Yeah, it looked like stocks were pretty quiet. They had of course, the bad start, but then into the week pretty strong. So not a lot going on there. For us, it's just a rally in the shorts and trying to still find those great longs. But as you mentioned, the grains and the precious metals, we got enough bad price action in the gold to get bounced out of our gold, and still hoping that something like cattle looks pretty strong. The emissions are hanging in there. But I think for us, probably a losing week due to the dollar and being on the wrong side, being short all the different currencies still. So not a great week. Hopefully next week's better.
Yeah, you never know. You can always hope. No, it's interesting. I mean, none of us seems to be trading lumber, but I think from what I've seen, other managers who do trade lumber, I mean, lumber had a pretty sizable move last year. I think it was halved in price. So it seems like for smaller managers, maybe it's an interesting market to trade, but I think it's pretty thin in terms of volume. So something to watch out for. And maybe I'll just throw in a little bit of a no, actually, we'll take that at the end. I think there's a couple of questions where it might fit better what I was about to say. So in terms of news flow, articles, anything, I think there was an interesting article this week, because I think a well-known magazine in our industry, CTA Intelligence, I think they published an article about how CTAs might soon be extinct. So that's always an interesting topic, something I'm sure we've all heard before, but this seemed to be pretty sort of dire forecast for our industry. So why don't we, did any of you look at it, and what are your initial thoughts?
Yeah, I looked at that. I mean, I think probably none of us who trade systematically can overlook such a piece. I think I read it on the Tuesday, and when I was done with it, it was kind of like, yeah, I mean, there's some points in there which are objectively correct, meaning performance hasn't been that great. But I also left, reading the article and thinking a lot of those things are just pulled out of thin air and made up, and creating this doomsday scenario without the objective facts backing them up. So I must say that even though I try to be very neutral, so if we read negative news about us, well then just take it for what it is. But in this case, I just thought the article wasn't well prepared.
If I may ask you, because I didn't actually see the details myself, what was the main argument for that this industry would be extinct?
One of the argument went that they said the smaller managers are going to be out of business, because if they don't come up with better performance in the next month or years, then all of the money will go to larger guys, and the industry will become irrelevant, so to say. I need to pull up the link to find out exactly what the passages were that rubbed me the wrong way.
Okay. What did you take away, Jerry, from it?
Well, I think that it's interesting that, I guess, to get readers, you talk about dinosaurs and extinction. These are pretty volatile words. They're funny. And a picture of a dinosaur, I think that's kind of cool. Yeah, and then what happens to the name of the magazine when we all go away? And then I put on my tweet, quote, CTA Intelligence is not an oxymoron, damn it. So I was mostly in a making fun of mood. I have a subscription. I'll keep my subscription, and that's fine. I might be extinct, and I'm making fun of you. Hopefully, the guys in London are okay with all of this. But I think it's just another doubling down on this whole idea of crisis alpha. Where were we in February and October? And no matter what we say, like, hey, can we kind of move on from that? There are short-term traders who are very good and very famous. You should give them your money, maybe all of your money. Why mess around with stocks at all if these guys can get in and out of the markets and provide crisis alpha just when you need it? Then maybe they just deserve to have lots of clients' money and not mess around with long passive stocks and protecting those movements. So no matter how long often we try to say to people, well, we're not that great. The CTAs, the trend followers, are not that great at crisis alpha. We do pretty well historically, because of our diversification into currencies and commodities, and because we do shorts, even index shorts, stock index shorts, that we can help in a bear market. Not good enough. We have a story to write. We have a bit money to raise, and it suits us to continue to criticize and force us to reconcile this idea of crisis alpha, even though we say we're not that great at crisis alpha. So I don't know if this will stop, but we do have a very good portfolio of longs and shorts and a systematic approach that is more of a perfect portfolio than a perfect hedge, even though of course, it doesn't look like it's that great as a portfolio either. The last sentence in the article, I have no idea where this comes from, but I guess it's just a quote, and it's CTAs focused on currencies and commodities can grow their business. Where does that come from? I mean, because maybe there's a few last year who made more doing currency only or commodity only, and this is the solution. Historically, going forward into the future, let's reduce our diversification, notwithstanding the many years of seeing the benefits of having more diversification.
Yeah, no, that seems to be an interesting conclusion on their side, which I agree with you. I don't really see any evidence for that. Moritz, did you find what you were looking for in terms of?
Yeah, I'm reading through the article as you guys speak. It's a long article, but it is about the crisis alpha thing again. I think yes, clients are redeeming. We've seen this over and over again, time and time again. Clients pull the plug when they are in a drawdown, and they get back in the highs, destroying their own return profile, so to say. And it just, that doesn't stop. And the other thing is, the article is written very much about being an equity hedge, and we've said that many times on this podcast that none of us believe that CTAs are an effective equity hedge. They may be by chance if they are positioned correctly, right? But not by design. And I know Katie Kaminsky has produced this article, and more recently I think she's written an article about crisis alpha versus correction, or crisis versus correction, something like that, which I think put it in a better light. And it's just so important for investors to understand that if you invest in a medium to long-term trend following CTA, whether or not you get that crisis alpha is really a coin toss. It's not designed to be a hedge, an immediate hedge for short-term corrections. And if that is what clients want, then they've jumped on the wrong bus. And essentially the article is exploiting that and saying that there have been those two corrections in the past year, and CTAs weren't there to help, and therefore it's kind of like the question is out there: do they value add, or are they a value added thing to investors' portfolio, and is it worth paying the fees for that? Well, there you go.
Yeah.
In 2019, this is the deadline. Says who? Says the
exactly.
author.
Says who?
Yeah. I mean, I think sometimes we all need to go back to sort of basic principles. I mean, we're talking about a strategy that is based on the fact that higher prices attract buyers and lower prices attract sellers. I mean, I don't really think that's going to change. So that's the fundamental principle that makes trend following work over time. So I think that's important to always keep in the back of our minds. And I think the other thing is, which is something you both talked about. I mean, when you build portfolios, I think there's no discussion that diversification is important, and I don't mean diversification within the CTA portfolio. We know that's important, but we also, I'm talking just by looking at investors and how they structure their portfolio. But diversification, in my mind, it doesn't mean that you can turn negative returns to positive returns. What it means to me, and I think we touched on this maybe in a previous episode last week perhaps, is that diversification, if done right, minimizes the variance of returns of your portfolio. And if you then look at compounding effect on portfolios that don't have these deep drawdowns, that's where you see a lot of benefit. So completely agree with you guys that we're not trying to avoid normal portfolios to have losses, but we are there as an uncorrelated strategy to minimize some of the volatility, to remove some of the volatility of these portfolios. And by doing that, if that's our role, that's perfectly fine. I think there's been a lot of different analogies written about that illustrates, the value of having something that may on paper not look great. I think there was, I think Chris Cole actually, who will be on the podcast soon in a roundtable, and he's the guy from Artemis Capital who's written some great articles about volatility. I think he wrote a piece about, and you probably know this better than I do, Jerry, but he used an analogy of basketball. And he was talking about how Dennis Rodman had been appointed to the Hall of Fame. But Dennis Rodman, when you look at his stats, it doesn't look that great. I mean, he's someone who doesn't score that many points. But what he apparently did, and I'm no best basketball fan, so take that or keep that in mind. But what he was great at apparently was rebounds. So he was better than, he had like a 6 standard deviation success rate on rebounds than any other player. So even though he didn't score a lot, when you put him on the field with other players, the whole team, the whole portfolio was massively improved. And I think to some extent, that's kind of the role we play. I mean, we may not be the ones scoring many points. When we do score, we score big. But we don't score a lot in that sense. We spend a lot of our time in drawdowns. Anyway, that's kind of how I...
Yeah, that's a great analogy. And that's those teams were just put together correctly. It's like that in every sport. You've probably seen in soccer or football that if you get a team full of superstars, it may not do as well as when you have Jordan and Pippen. You don't need another person wanting the basketball. You need a guy who does something else. So that's the way those teams were put together to a complementary role. And he was an amazing rebounder. And so, but you know what? He didn't play 2 to 4% of the time.
Right.
He didn't make a little bit of money.
Yeah.
He was treated as a cog, a worthwhile person on the team. He was paid millions. He played all the time, just like the scorers. And so the allocators to long-term trend following, they don't even believe that we're that good for Crisis Alpha when they're only willing to allocate these small percentages and be so careful and to not be able to hang on for a long time for a complete cycle or two for CTAs, and even though it's just a small percentage of the portfolio. So now there are some things that we need to do better. Let's say, how can we earn? If everyone all of a sudden says, yes, I agree, no more Crisis Alpha talk. It's help me have a better portfolio. You have all these markets, long and short, systematic approach. Can you do something about the consistency of your performance? And I think, we need to have more consistency of performance. And how can we do that? So there's some things that we can, obviously work on, but it is a little irritating to.
But you say that, Jerry. I mean, it's interesting, and I completely know where you're coming from. That consistency in performance would make it more appetizing for investors to put us in their portfolio and maybe keep us for longer. But on the other hand, one could say it's like if you try to change a Dennis Rodman to do something different on the field, you lose the value of what he really stands for. And I think sometimes if we start trying to do too much to our systems, and we've talked about this before, that there is no best system, right? So if we try and do too much, being too clever just to please people, I think they will end up losing the real value that we produce. It also reminds me of another analogy. I saw an interview at some point with Michael Lewis, the author, and he was talking about Moneyball. And I think a lot of our listeners probably is aware that Moneyball kind of is an interesting analogy to our industry because they're all about the statistics and so on and so forth. And it's been written about a lot. But one of the things he said was, and I don't want to make it too visual, so to speak, but he talked about the first time he ever went into the A's locker room and he saw these guys walk out of the shower. And he was looking at these guys and they were kind of misfits in his opinion. I mean, they didn't look like athletes. I think he said they looked like, no disrespect here, Jerry, they all looked like accountants. He said, they were not very fit and all of that stuff. And it's true. I mean, we don't have to look like all the other guys. And I think actually there's a question coming up later that is kind of in relation to this about how the look and feel of someone and the value they can bring to your portfolio. If you look good and smart and have a certain, persona, there's more likelihood you're gonna raise a lot of money. But I wonder whether that's what people really should be looking for. Anyways, that was just my thought.
I agree. I agree with all of that, and I think, honestly, I can't really think of too much that I could test in the morning, and try to improve, and so I throw it out there as just, sure, maybe we can improve a little bit. Let's add some single stocks. You're going to hear that every time from me, right? Okay, so let's try to get a little bit better. But honestly, no. And another good analogy, if Rodman has a couple of bad games on the bench, right? No, of course not. CTAs have some bad periods. Oh, that's over with. Trend following is on the way to extinction. Yeah, so these are great ways of looking at it, and people operate their life in a certain way. Let's look at all the data. Let's play for the long term, especially with our long equity managers. So with CTAs, nope. Next stop, extinction.
Yeah, I really like that analogy too. I think it was on Meb Faber's show, the interview with Chris Cole. And it is so true. I think you just need to keep the CTA allocation in there permanently in your portfolio, and then combine that rough strategy with other strategies. That could be Chris Cole's vol strategy, could be short-term trend following strategies, things that we don't do, and build that portfolio, which, just as you said, Niels, because of the fact that it's so uncorrelated and it has these rough diamonds in there, all of them together, just stick to that one. And don't, become too emotional about 1 year or 2 years that haven't been going so well for one of the strategies included, because odds are that the other strategies will be doing fine.
Yeah, and on top of that, I would say, and I think you mentioned this before, Moritz, and that is if you go back in the history of trend following, right? And I know that you could argue that some of the studies that's been done has obviously been back testing, 100 years or whatever. But you certainly find periods where trend following didn't work for 5 or 10 years. But and I'm sure had there been articles back then about trend following, had it been a widely known strategy, these articles would have been out there saying it's never going to work again. But funnily enough, you never see that after equities have gone down. I mean, from 1966 to 1974, equities went down. I mean, that's, it took 8 years to make that low as far as I remember. But I don't think people would ever call or would ever say, equities, that's never going to go up again. So we're never going to invest in equities anymore. It's funny how there is this kind of double standard when it comes to these strategies versus but maybe it's just
cognitive dissonance. It's the mind trick all over again. It's just like what we had in the last quarter of last year with the equity markets, where they were heading down 20%. And when you then read the media, maybe that's all about creating ad dollars and getting the story out and just getting people to read stuff. But it sounded like this is really, really bad, and this has been the worst December. And then when you look at that and put it into historical perspective, the range between the highs and the lows, the realized volatilities, all of that has been a blip compared to events in the 1930s, even the global financial crisis at the end of the 2000s. It's just people forget about that stuff, and they only, we only live in the right here, right now, in the present. And apparently, it seems to hurt so much that you lose the interest in actually trying to put it in perspective. I mean, some people do. We do it. We, like those articles on Twitter, the objective articles as they come out, and, try to make people aware of the fact that, what's happening right now is just a, smaller episode of a longer term, trading game, if you will. But it's for no avail.
Sure.
And, I'm so upset with those CTAs in the 20s and 30s that caused all that volatility as well.
Yeah, exactly.
Yes. Exactly.
I'm mad at them too.
Yeah, we have to blame someone. Let's start with the CTAs.
And as another, the topic you brought up, I think last week, and maybe you tweeted some this week, Niels, was we're running out of long-only stock markets that make the case for that you don't need to do anything. You don't need to have small losses and a systematic approach or diversification, just passive indexing. It used to be they could say, and you can please just ignore Japan if you don't mind. But then there's a lot of other stock markets, especially in Europe. So these are developed Western countries that it's, and I'm just waiting when maybe the S&P is on its way as well, where maybe it will be one index, not the NASDAQ, not the Dow. Now we're only up to the S&P that we can kind of rely upon forever and ever, as if this is some sort of great scientific, evidence-based idea that we have proof here that, that passive long stock indexes, ironically, this is, I think it's being more and more difficult to make that the case and proof, since a lot of these other markets are not showing profits in many, many years.
I mean, I think that's a great point, right? Because every time we get compared to the S&P, and we know that the S&P has been, the most, profitable of the equity markets, or at least consistent and then profitable in recent times. So we always compare to that. But you're right. I mean, the point I was making in last week was that if I look at European equity markets, many of them made their last high in 2000. And some of them were made their last high in 2007. So there we have markets that are either in an 18-year drawdown or an 11-year drawdown. And only very few made their highs in 2018. And yet people, of course, don't stop, investing in France or can't remember the names right now, the UK, et cetera, et cetera. Now, of course, you need them in the portfolio, but it doesn't change the fact that they have actually had drawdowns that are by far longer than anything the CTA industry has ever experienced.
I found the tweet and I tweeted that, Niels, we only have to go down from where we live 100 or 200 kilometers south, and there's Italy.
Yeah.
And the MSCI Italy gross total return index is at 0 for the past 25 years. Now that's gross total return, not net total return. That's before taxes. So,
yeah,
Italian taxes are high, so it's negative for 25 years. And, people only focus on, I think Japan is this dormant market which hasn't rewarded investors for the long only allocation. And I think there's many more. Italy is just one example. And then the spotlight is on the S&P 500 and how well that has behaved in the past, 10 years, now with maybe a lofty valuation. Nobody's to say that, there's no rule that says that the S&P 500 cannot have a 25-year flat period. It may happen. That's just entirely possible. But apparently the mindset isn't there for this.
That is possible, and I think we should always also remind ourselves that we don't necessarily wish for these markets to go down, and we we can make money just as easily when markets go up. 2014 was a great example of that. 2017 was a great example of that. I mean, so it's not like other things the bad things has to happen to other things. We again, I mean, crisis alpha is something that a lot of people talk about when they think about our industry, but I mean, we don't need a crisis to produce alpha. So, we should keep that in mind as well. All right. Okay. Great stuff. Why don't we bring it back to the present? Let's bring it back to this week in social media world. Let's bring it back to Jerry's top tweets. I know there's a surprise winner this week, so I'm excited to hear what that was, Jerry.
Okay. It's a surprise winner / loser. A lot of popularity. I have no idea why. I'm throwing things up against the wall and seeing what sticks sometimes and just having fun. I think some of these things, I don't agree with them necessarily. One tweet this week was one of the explanations of what is an algorithm was compared to an algorithm could be like the directions on a shampoo bottle, rinse, lather, repeat. I thought that was kind of funny and it got some attention. I have no idea why. But so this one was a very frustrated person. My comment was maybe a bad day in the markets. And the title was Trading Will Never Make You Rich. Trading for a living is not an ideal way to earn money, and it's a sublime way to ruin your life and embed yourself into a permanent state of frantic misery. Opt for long-term capital appreciation, long only tactical allocation, I guess, for the sake of your own sanity and quality of life. So I think, you're going to have these periods if you're not being systematic. I remember in 2008, we would have some clients into the office to talk about what was going on, and they were so depressed. Once again, small allocation to Chesapeake or CTAs, lots of allocation to indexes and long stocks, and no clue what to do. And that's one of our great advantages. We know exactly what to do with a systematic approach. Unfortunately, it doesn't look like we do, and it doesn't always work. But the next trade, we've got that part down. And so I think just maybe these type of feelings and anxiety are mostly due to people who don't use a systematic approach or trade too large. I mean, I think that's 90% of it for most people. Even if they're going with the trend and taking small losses and being somewhat diversified, they maybe have too much leverage, too much risk on each day, and then it all starts to unwind. Chaos starts. But there are people out there who like to trade, who want to trade, and they just realize that the ups and downs of the markets are just too personal and they're too much to handle. And I think a lot of people identified with this article.
Yeah, I think that's true. I mean, I think that that's exactly another element that being rule based brings to the table, because I agree. If you had to sit in front of the screen 8-10 hours a day, if that can do it, and try and make money from it day in, day out, that probably will ruin your life. But having these rules, and it's interesting, I'm putting together these weekly kind of summaries of old episodes on the podcast, and the one I'm working on right now that's going to come out, I think, next week, is one with Scott Billington from Covenant. And of course, they only look at the markets once a week. And, so again, I mean, you can do a lot with the right rules, and trading doesn't have to be, consuming all your time. And if you get it right, and then there's a lot of other great things you can do with your time. But if you are discretionary, as you say, Jerry, and you have to sit and try and make sense of it, and with the news flow as they are today, and a tweet here and a tweet there, changing things dramatically, I think that probably is the way to ruin your life.
Everybody gets what they want out of the markets at Seibert. Yeah, I mean,
Nice.
it is true. I mean, for some people, they want to sit in front of the screen and, day trade. I'm not sure why, but, maybe that's for the fun of it. Other people, they want to be right more than making money. So it's a mixed bag. And there's something in there for everyone.
Very true. So that was an interesting one to kick off the social media review with. Jerry, what else got people's attention this week?
I like to read things in the media and in social media, and just sort of run it through, the trend following lens. And so often it's just a repeat, and but just reminding myself of how wonderful and how organized. I think to some degree that's what Google says, that they want to do with the search is organize life, organize the world. And that's sort of how we go about it. We organize these markets. There's so much complexity. One of the articles that I looked at this week was, models. Models don't work very well. And so I'm so thankful what we do is not really a model that is going to be 50-some% correct and predict the future. We're the opposite of predicting. We're making money 40% of the time, let's say, or something like that, less than 50% probably. So some of the articles this week were like, one of the articles were something like, go back and look at your trades and your worst trades and see how you can improve them. And I thought, my worst trades, I mean, these losses that I take, I've taken some losses this week, but they're like my best trades because I have my predetermined stop loss. It's going to be a small percentage of my AUM. And so I really don't have anything to improve upon with my trades. And as a systematic trader, the things we need to evaluate each week would be things like, why didn't I do the trades I was supposed to do? And then can you imagine not wanting to take those losses? Well, then that feeds into not wanting to take certain trades. If I only hadn't taken those trades, well, then that feeds into missing huge trends. So from our perspective, it's a little unfair for me to jump on some of these quotes because they're just from a certain perspective, which is not systematic and hanging in there with your system and doing long-term back testing to make sure your rules look pretty good. So I really kind of enjoy reminding myself how awesome our framework is. And that's why we all sit around saying, yeah, we can tweak it a little bit, but most of these tweaks are not going to matter so much. We will step on the field with a systematic approach and all these great markets, long and short, and we're 90% ahead in front of everyone. Our edges are so huge just by the mere fact that we're willing to follow these trends.
I mean, I think that's a great point, Jerry. And I think a lot of this sentiment comes from people who probably think, yeah, I mean, rules make sense and I should be systematic. But then there's the mindset, right? The mindset and the time it takes to build so much confidence in your own system that you become 100% systematic. I think a lot of people are 99% systematic or 95% systematic. And that's exactly right. As you say, you sometimes then would miss out on the next great trade because you didn't take it for some reason. And I think that's the evolution of many investors where they think they're systematic because they're systematic the majority of the time. But in our world, you're either 100% systematic or you're not. And I think that's that could be tough for people to get to that point. And I'm sure it's taken all of the three of us, plus a lot of our great peers, some years to get to that point where we're just so comfortable with, what we do. I think that's a great reminder.
Yeah, take some time to start loving your losers, and that's really important. And I love those losers. I can remember days and periods where, I looked back on a losing trade, and then, the day you get out, you realize that loss, and it feels bad. And then 2 weeks later, you look back on the market, and the market has gone further into the wrong direction, and you feel absolutely fantastic and joyful because you've only lost 25 bips on that trade. And had you hold on to the trade, you'd be like in a 3% hole or something like that, right? And nowadays it's even, those, instances happen where, you look on a specific trade, a losing trade, and it makes you feel really good because you followed the exit and, you just realized a small loss, fine, so be it. And now I just put it into the larger sample size bucket and go, well, that has been one trade of many, many thousand that are still to come. And it's, just one of the statistical outcomes and doesn't really mean much.
And you look at these weekly charts and all you see is these monster trends just pop out from a weekly point of view that last a year or two or three. And I often look back at some of these trends and I see, right before that big 2-3 year trend, the LME in 2006, six-ish, maybe there was a whipsaw, and I'm thinking, what was I thinking? Oh my God, I can't stand. I had a bad day, a bad month, and then all of a sudden, you don't even understand, but you're on a 2-year trend in copper, aluminum, nickel, and zinc, and making all kinds of some of the best trends of all time. And so your brain is absolutely in the wrong place. It's not, oh crap, I got knocked out of gold last week. It's like we should be, I can't wait to get long gold or maybe get short again, because it'll be a better trade on the short side if we all kind of get long or get very frustrated about just getting knocked out of our short. So we don't see that opportunity. Once again, the rest of the world, if I wasn't trading systematic, I would be, my emotions would have an impact.
Yeah,
there's another. I think it was this week with one of the finest trends at the moment. Uptrend is in the palladium market, and I'm sure we're all along that. And so I think it was this week or last week when I read that an article, I think in the FT, saying, "Is this now a time to get long palladium?" I was like, well, if you aren't long palladium by now, then I'm not sure what you're trading, but certainly you must have been long for a few months. That question doesn't even come up, but systems are great. Just love it. And the losses are part of the thing. It's the byproduct. You have to embrace them and love them in the same way.
Yeah, absolutely. And sometimes you can't see the forest for the trees. And that's why, having something very concrete to hold on to on a day-to-day basis is very useful. Great stuff, Jerry. How does third place look like this week in Twitterland?
Yeah, well, I think what prompted some more of my thoughts were the continual idea that people are looking at these markets as long only. How do they perform long only? It was an article about commodities and what they look like for the future. And if you have to look at these things, long only, it could be a problem. But the great thing about the trend following approach, systematic trend following, is these markets can be added to your portfolio, these commodities, and they will be profitable. It's nothing to do with historically looking at have they added value to the portfolio on a buy and hold basis. But when we put them in a portfolio with trend following, they will be profitable. They will add diversification. And we don't have to really worry about the value or the prospects for the future. They instantly will become worthwhile members of the portfolio. And over a period of time, long period, they will add value. One person tweeted, if you're long 200 stocks and you think you have diversification, well, you won't have diversification sometime. They'll all go down, in October and February, for instance. True, but the minute you overlay the trend following to it, it can do nothing except add diversification. So even if it's stock only, and this is I live this every day. It's almost like I'm on a mission. The CTA is kind of on this mission not to find the 200 best stocks. Oh no, I don't want to find the 200 best. I'd like to find some that I'm long, I'm short, and I'm flat. So I'm kind of trying to underperform the S&P. I think I'll do my job better if I'm underperforming the S&P in a big bull market. I'll take the profit in 2013 where we made it. Every stock I had was in an uptrend, but I knew hell was coming in 14 or 15 when they sold off, and it did. But trend following can only help, even if you're only going to trade stocks and only want to go long. At least if you use a trend following approach, you'll probably be flat, probably be short quite a few stocks when that bad period does come.
Yeah, I think that's a good point. And I think the other thing, and this is a little bit from memory from an article or an analysis I read a few years ago. So, again, just keep that in mind that I could be completely wrong, of course. But I think it is right when I say that unlike equities, where there certainly is an upward bias, and so that's part of why, buy and hold in equities for many people seem to have been the right strategy. I do remember or seem to remember that in commodities, the world looks a little bit different. Over a 30-ish year cycle, I think commodities in general only spend 10 years going up and 20 years going down. So if you apply a long-only strategy to commodities, and of course this was frankly made famous by probably 18 years ago with Jim Rogers' commodity indices, et cetera. But if you just took it as a long-only investment, I don't think that's been a very good investment in many cases. So be aware of that as Jerry says, a trend-following approach to these markets, in many instances is a better approach than just being long only. And okay, if you don't want to take the short trades, then don't. But still apply a trend following approach to avoid some of these nasty losses that will come from a buy and hold or buy and hope strategy.
And then there will be a period where we will show our attribution analysis, and it'll show profits for the month or the year in stocks. And people say, well, how did you do that? Stocks were down 30%. Right. How were you able to do that? Oh, you must have been short. Yeah, I was short, but also I made some money in the longs as well, or only in the longs. What the heck? Yeah. Once again, it trend following rehabilitates and creates profit in markets that may not have been profitable if you look at them in sort of the traditional way. If you remember, I've mentioned this study before. Oh, someone posted something about Alpha Architect. He posted something last year about value stocks and buying overvalued stocks, that you make less money. And I said, oh, is that true if you apply trend following? He goes, no, not true if you apply trend following. And I was like, no, of course it's not true. Trend following is not subject to these traditional ways of looking at things from long only. And then I asked my friend Eric if he agreed. He says, oh, I agree totally, because, one of the facts is that so few stocks, 4% of the stocks historically, are responsible for all of the gains. Right. And so he said, and one of the things that he did was he took a list of delisted stocks, the stocks that went out of business and were no longer around. And he said he did a trend following test on them, and they made almost the same amount of money as the stocks that were still in existence. So even for markets that don't exist any longer because they went to zero or they got, whatever, some of them I'm sure got bought out, trend following turns those into profitable markets.
Yeah. Great stuff. I think we're having a lot of fun this week with some good topics. What else came up in the social media world, Jerry?
That's about it for the good stuff. Hopefully we have some good questions.
Yeah, we got a couple. And the first one is from Francois. Thanks very much, Francois, for sending in this question. And by all, I should just plug to everyone listening in, we do really love your questions. So send them to info@toptradersunplugged.com or tweet Jerry or myself or Moritz, and we'll definitely try to bring them on the show as quickly as possible. But by email, it's easier, certainly for me, to track them. So please do that. Anyways, back to the question. It goes like this. Most of the people believe that it's safer to invest with someone who wears expensive suits, who pretends to spend hours reading financial statements, and more importantly, who can explain every move of the market. The narrative is very soothing and somehow comforting. How can trend following compete with that? Not to mention that trend following systems are by nature pretty hands off. Trend following managers seem to have lots of free time, which can be seen as too good to be true. So maybe a little bit back to what we talked about earlier. So Moritz, how can we compete with the expensive suits?
So how do you compete with the global macro manager who goes sees a client and has a hypothesis on, I don't know, Italian bonds or the spread of Italian bonds versus bonds? I don't know. We don't have that. In our tool case, we don't make those statements, or at least I don't make those statements. I'm sure you guys don't either. But the quality of us is that we have rules and a robust methodology to react to prices, and we say that the information that's relevant to us, that's the price. That's as good as it gets. There's nothing better than that price in terms of signal. And we've developed rules with all the free time that we have to come up with that great portfolio that's highly diversified, very stable, and producing good returns for the long run. Of course, this is that doesn't sound like I know what the world's going to do tomorrow, and that one market is going to outperform the other. But it's, what can I say? I've never been in that situation where I've kind of like been pitched against another manager in such a competition. So I don't know. Looking at the performance, I mean, there's the graveyard on all sorts of managers who then underperform. They come up with those statements and they say this is going to happen, that is going to happen. Then it's just it doesn't turn out to be true. So I always want to be very careful about providing an outlook for the future. Isn't there that saying that outlooks for the future are very risky, especially, or something like that, especially about the future? I don't know. It's just not my cup of tea.
What do you think, Jerry, on this one?
Yeah, I think it's we probably have a lot of time on our hands to get ourselves in trouble and do too many tweaks and too many changes. So we're cursed with a strategy that it works, and it sometimes doing less works better. Not to get too fancy and make too many changes and try to improve upon periods where there were no profits to be had. So I'd like to do less and less. I think I do less. 35 years of doing as little as possible, and with my approach, assuming as little as possible, So I think I'm very happy with that. When I look back and I see what happens with the markets and where I've made mistakes, I can find these trends that if I just would have got on that trend, or thankfully I got on that trend, it would just overwhelm any sort of good idea that I've ever had. How much value did I add with my latest tweak is not nearly as much as being long platinum, long emissions, short crude in 2014. So things like you sort of quickly figure out that the markets are the heroes, and just having them in your portfolio and doing those trades. That's why you can see, somewhat maybe inferior systems. My own original systematic systems that I used, we had great performance. We're much better now, quote unquote. We need to be much better, but we're helpless without the good trends.
I mean, I think what Francois is bringing up is it's certainly a point that you come across. I have a few thoughts about it. I mean, it's true. I think people or investors tend to gravitate towards someone who can speak, or is perceived to speak intelligently about the future, right? Where it says, yeah, I think Apple's earning is going to be X, and that's why I'm long Apple. I think a lot of people take comfort in that, even though there should really be no comfort in people's guessing about the future, because nobody knows the future. But I understand where you're coming from, Francois, and maybe we need to. And I've seen many interviews with, say, David Harding on CNBC, where they kind of struggle. They always end up asking him the same question. That is something, so where's gold going? And he obviously always tell the same answer. He doesn't know, and he's not meant to know. So I do understand that from a public relations point of view, that could be a challenge for us in the industry. I work at a firm where there is a no tie policy, so we don't dress up per se to look so polished maybe as some of these people. But I think the truth, in my opinion at least, is that investors should be comforted by meeting people that are authentic, that are real. And I know that some of the people that I like and respect in this industry are just really straightforward. When you see them, they sit in normal clothes. They don't dress up for their videos or anything like that. And they're some of the smartest investors out there with the best track record. So again, we shouldn't be fooled by these things, all the glamour. I don't think investors should be fooled by that. Look at the numbers, look at what people are actually telling you. How transparent are they? Does it make sense what they say? Can they prove what they say? Meaning, do they have a long track record that people can grab onto? Like Jerry, like Don, and a few other people. That's what should be important in my opinion, not how they look, what they dress like, and how eloquent they are when they talk about the future. But I agree with you but I don't think necessarily we need to compete with them. I mean, I think we should just be happy doing it in our own style, and there's enough investors out there for us as an industry to do well. But I understand the point for sure, and we appreciate your question. George is back with another question here, another great question, which I think is very relevant again, that people need to think about, and is something that we're often questioned about, I think. So here goes from George. I've heard historical trend following returns benefited from investing in difference between required client capital and required margin to equity. I'll explain that in a second. In historically high interest rates, recent trend following returns have thus suffered as interest rates have fallen, removing the source of return. Any thoughts? I think what George is referring to, and I know you, Moritz and Jerry, are familiar with it, but I want to explain it to our listeners, and that is, with a CTA or a trend follower in particular, we generally tend to only trade futures contracts, and with futures we only have to post a small amount of cash to get the margin requirement covered, so that we might only post, say, 10%, 20% of the cash we get, in order to do our trading. So we have 80% of the cash that people invest, and they go to the money market, or they go to short duration bonds, et cetera, et cetera. So now in the old days, post or prior to the financial crisis, we had reasonable interest rate levels, 5, 6, 7, 8%, if we go back in time. And of course, post financial crisis, that has been zero. So that part of the track record has gone out, and it's a great point, because you could certainly argue, when you look at the index for or for CTAs in general, but actually also for hedge funds, that a big chunk of the lower performance post-financial crisis has come from the fact that we've all lost the risk-free interest rates in our track records. But if I just continue a little bit further and just kick it off and saying, well, if I look at it from our point of view and our firm point of view, that has not stopped us from producing double-digit return in the last 5 years, for example. Or in the last, I think since 2006, it's double digit, even with zero help from that. So you could say that's pure alpha, and so again, investors will have to do their due diligence to find the managers who can deliver those returns and who are not reliant on any risk-free rate of return to boost their performance to a level that is acceptable for the client. But this is something so it's kind of interesting, right? Because we as an industry, hedge funds, CTAs in particular, with a lot of cash on hand, we've really been penalized by low interest rates. The people who are very popular right now, things like private equity, they've actually benefited because they can take on leverage at hardly any cost. So their returns look great because they don't have to pay for financing. And of course, they don't have to market their returns either. They can, quote unquote, make up their own track record to some degree. And I know this is a bit harsh to say that, but there is some leeway on their side in terms of how they mark their own positions in these companies. Maybe that's been reduced a little bit in the past couple of years, but certainly that is why their performance is much more stable, less volatile than ours, because we have to market every single day. So this low interest rate environment has really hurt our part of the industry and helped another part of the alternative investment industry, which of course today is incredibly popular with investors. I think it's dangerous to, if you're not aware of these things, to overcompensate your allocations to these less liquid strategies, but that's just reality. Anyway, those were my thoughts. Moritz and Jerry, what do you think?
I think you've said everything that needs to be said there. Everything's 100% correct. Maybe the one thing that I can add is I think that, us included, everyone, we should have a hurdle rate equal to the T-bill rate. If you have a US dollar account, we shouldn't be compensated with performance fees for the tailwind and the drift that the 80% of the cash generates that we don't need for margin.
Yeah, that's a good point.
I have a slightly different view, and hopefully I'm not totally wrong. It would be embarrassing. But as far as I think, the amount that the pricing of a futures contract will be impacted by rates. So to buy the S&P index, we have to pay more than if we bought the SPY cash in an ETF or something. So, and so we did lose rates. We did lose interest income, but we also purchased that S&P for less because rates are so low. And so it's kind of an offset, kind of a wash to some degree. Not true in all markets, not necessarily true in commodities. And then, of course, when it was true that a commodity would be higher priced or financial would be higher priced when rates were higher, it didn't seem to help our shorts at all. So, and I don't think I would be in favor of this hurdle rate based upon the interest rate, because if I trade single stock futures, I'm going to have 80% or a large percentage of my AUM in treasury bills, But if I bought the same single stocks in the cash market, I may earn no interest for example. And so I'm going to get sort of penalized because I just decided to use leverage. Didn't really need it. Just decided to do those trades in the single stock futures markets because it was more easy for me, and the account was already set up, whatever. So we could both make the same amount of money on being long these stocks, but in each account, the cash account or the futures accounts, but I would make less because I had a hurdle, and this interest income was sort of deemed to be a freebie that I should not get credit for. Does that make any sense?
I think it does make sense, and I think you're absolutely right. But of course, what we need to take into account is, of course, whether we are long or short, right? So sometimes the positions that we take in the futures markets can actually have a little bit of an uphill battle because of how interest rates are. But it depends on whether we are then long or short that market. I think, for example, that something that I think was debated a long time ago, at least a couple of years ago, was this thing about, and I think this was if I'm a little bit cheeky here, I think it was the short-term traders who made the point about long-term trend followers would not be able to make much money in interest rates going forward because interest rates were going to go up, so we're going to lose the roll yield. Well, actually, long-term trend followers have been doing pretty well in long-term interest rate futures because that's where the trends have been. So again, one needs to be careful about these predictions because the interest rate level is important, but it's also important whether we're playing the trends from the upside to the long side or to the short side. But I think you have a good point there, and managers, of course, can always choose when they do their products, their funds, to whether or not to include the interest income that the fund attracts in the performance fee calculation. There's nothing stopping managers from doing that. So whether it's right or wrong doesn't really matter. A hurdle rate per se is not really needed. You can just exclude interest income in your performance fee calculation, in my opinion. So, but great questions. Thanks so much, George. And that wraps up the questions for this week. So while Jerry and Moritz, you think about anything you want to say to wrap up our conversation, let me just give people a rundown of performance so far this month. This is as of Thursday. I think Thursday was the 24th of January. And I know Friday was not a great day for trend followers, so I imagine the numbers will be worse Friday night than they were on Thursday. But the beta 50, not very much difference from last week, minus 1.58% for the month and therefore the year. SocGen CT Index down 1.76% for the month. SocGen Trend Index down 2.81% for the month. SocGen Short-Term Traders Index down 1.56% for the month. And Bridge Alternatives, the flat fee funds, down 3.24% for the month and therefore, of course, also for the year. Any final thoughts now that we're heading into conference week here in Miami? Two big conferences in 1 week where I'm sure we'll have some interesting things, maybe some interesting topics to talk about next week when we get together on the podcast. But any final thoughts?
Yeah, looking forward to seeing everyone and speaking to a lot of people. But we're nearing the 1-year anniversary of the VIX spike, right? I think it was early February last year. So maybe there's an opportunity for that beloved crisis alpha. I'm still short the equities. Let's see what happens next week and the week after. Happy trading.
I agree. And all I can think of is though I'm not short this indices. I would just follow the system for all you guys out there who are. If you have to take a small loss, they're kind of rallied above. The U.S. indices are sort of above that big breakout level. That's okay. It's just because you had a big profit and it turned into a small loss. Try to maintain that position. It's been many times I have made a mistake and kind of missed a trend. I kind of screwed up that Italian bond thing. I wasn't able to get that trade on. It just was so volatile and I couldn't do it. And then I talked to my friends and I said, yeah, that's going to be fine. Just keep that trade on. Okay, it ended up losing money, I guess, or not making money, but still, I'm encouraging everyone, make your bottom line. How am I handling this trade? How is my system handling it? And if you're still following your system and still short those indexes, you're doing great. Encourage, because we never know what's going to happen. We believe in the price trends. We believe that over time, these trends, and it's worth just following the prices. But the last few weeks of prices, they don't really mean very much. There's no indication of necessarily what's going to happen with that, with your great short index position. So I'm encouraging everyone to hang in there with those.
Good stuff. With that great advice from Jerry, we're going to wrap up this week's conversation, which we hope you enjoyed. Keep your questions coming by sending them to info@toptradersunplugged.com or send us a tweet. And if you like what you heard, please help others discover the show by leaving us a rating and review on iTunes. And please share this episode with a friend who also have an interest in investing. One share is really all we ask for. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.